you don't know where to begin, better ask Win.
Shane, good to see you. Today we are talking through 3 ways to reduce your IRMAA for Medicare Part B. If the Social Security Administration considers you a high-income beneficiary, you will pay a surcharge known as the Income-Related Monthly Adjustment Amount. So first tier starts with a modified adjusted gross income of more than $103,000 if you are single, and then $206,000 if you're married filing jointly. So Shane, let's start high level. How does IRMAA work and what could cause the penalty?
Well, just like you said, Erin, it's a penalty on your Medicare premium effectively. So if you have a high modified adjusted gross income, you could be subject to this penalty, which will effectively increase the price you pay for your Medicare coverage in retirement. And it basically comes from things that increase your taxable income, like distributions from IRAs, 401ks, earned income, and the like.
All right. And just to point out for people looking at the chart, it's a 2-year look back, right?
It is. Yes, it is. So you can't, you can't just try to drop your income for 1 year and start your Medicare and get that lower IRMAA. They'll catch on to that one.
Yes, they do. All right. So now let's talk through the strategies then to reduce the penalty. First, Roth conversions. Why?
Well, Roth has a lot of advantages, and it's talked about in many different ways. But as we relate it back to trying to avoid the IRMAA penalty, it comes to a conversation of having taxable income versus tax-free income. And a tax-free dollar always goes a lot further than a taxable dollar. But as it relates specifically to this situation, if you have income coming from a tax-free source in retirement, you won't have to worry about increases on your IRMAA penalty, taxes on your Social Security, and other taxes in retirement. So if we can shift from always taxable income to never taxable income, there's a lot of advantages that come your way. And especially as we're talking about Medicare, you won't have a penalty.
Mm-hmm. Next, you say open and invest in a health savings account. And these are uniquely triple tax advantaged.
They are. And as we get into retirement, a lot of our expenses can be due to healthcare costs. So if we have a tax-free pool of money to use to help pay for the cost of care in retirement, that means we don't have to tap into our 401k money, IRA money, and other assets to pay for those costs of care. And therefore, we don't have to worry about driving up our modified adjusted gross income in retirement.
I see. And then last, you suggest people consider a qualified charitable distribution. How does this work?
This is a good option for someone who's charitably inclined to get money out of an IRA account without having to pay taxes. So you can take your RMD from an IRA or other qualified account in what's called a qualified charitable distribution and send it off to a charity of your choosing, and that would be a tax-free event. You wouldn't have to pay tax, therefore it wouldn't drive up your IRMAA penalty, it wouldn't drive up the tax on your Social Security, and it can be a good way to move money around and give to charity without having to pay taxes.
Yeah, that's a win-win for everybody. Shane, thank you. Obviously, some of these strategies, the sooner you can put them in place, the better. If somebody wants to consider one of these and talk it through with you, how can they reach you?
Well, the best way to reach us is online at winstonandcompanies.com. You can schedule a visit right there or visit our phone number at 602-456-1928.
All right, perfect. Shane, thank you so much.
Thanks, Erin.
Got a plan for your retirement, 'cause you know it's just down the road. But if you don't know where to begin, better ask Win.